Now that you're inside Tradovate and looking at your charts, you might be wondering, what do these candlesticks actually mean? And why does price keep going up and down like that? Before we talk about indicators or patterns, let's answer the most fundamental question. Why does price move at all? It all comes down to supply and demand. Think of it like iPhones, right? When the newest model drops, everyone and their mom wants one, but there's limited supply, so prices stay high. You might see that a new iPhone is selling for $500 above retail price on eBay because buyers will pay whatever it takes when supply is scarce. That $500 markup is actually what's called a supply level, meaning resellers won't sell for less because they know that demand is there. Now, if you flip that around, say you're trying to sell your 5-year-old iPhone and the new model just came out, you might get some lowball offers, but you refuse to take less than $300 because that's what you think is still worth. That $300 is your demand level, below that price, and you'd rather keep it than sell it. In the markets, the same sort of psychology exists. Supply levels are where sellers say, I don't want to sell for anything less than this. And demand levels are where buyers say, at this price, I'm definitely buying. The same exact principle drives every movement that you see on your trading screen. It's just people's psychological price points playing out electronically. Here's the simplest way to think about price movement. It's just a tug of war between buyers and sellers. When more people want to buy than sell, buyers have to compete with each other to get filled. They start paying higher and higher prices, and that's what pushes the chart upwards. You'll see this as green or bullish movement. On the flip side, when there are more sellers than buyers, sellers have to keep lowering their prices just to get out of their positions. That's what drives the market down, and you'll see this as red or bearish movement. So what actually causes these shifts in pressure? A few things can do this. For example, news and events like economic reports, Fed announcements, or geopolitical headlines. Even market sentiment like the emotional side of trading. Greed, fear, FOMO, panic, all of that can really cause the market to move. Technical levels like support and resistance zones where traders make big decisions to exit or enter positions. Every time you see a candle move on your chart, it's just that, buyers and sellers reacting to those forces in real time. All right, let's break down what you're actually looking at on the screen. The horizontal axis, which is the x-axis, shows the time. The vertical axis, the y-axis, shows price. Each movement up or down represents real traders making buy and sell decisions in real time. Now, let's talk about candlesticks, the building blocks of every chart. Each candlestick tells a 4-part story. Where price opened, the highest it went, the lowest it went, and where it closed. The thick part is the body. That's the range between the open and the close. The thin lines, called wicks or shadows, show how far price moved beyond that before snapping back. If a candle closes higher than it opened, it's green. That means buyers won that round. If it closes lower, it's red, which means sellers were stronger. But here's where it gets interesting. Let's say that you see a green candle with a really tiny body but a really long bottom wick. What is that actually telling you? It's saying, hey, during this time, sellers push price all the way down. That's where that long bottom wick shows. But buyers came in so strong that they bought it almost all the way back up. The buyers won, but barely. Compare that to a green candle with a fat body and tiny wicks. That's buyers saying, we're in complete control here. We push the price up, nobody can stop us. A candle like that might signal a continuation of the current trend. It's like that iPhone line where everyone wants one and no one's backing down. The wicks of each candle are like battle scars. They show where the real fights happened between buyers and sellers and who ultimately had to retreat. And we can actually use this information to predict where price might go next. And here's how you read price action through these patterns. You're not just looking at one individual candle. You're actually reading the whole story of multiple candles together and how they interact with key supply and demand zones. For example, are the bodies getting bigger in one direction? That could signify momentum building. Are the wicks getting longer on one side? That could show you where the real battle line is drawn and a possible reversal. Think of each candle as a sentence, and you're reading a paragraph of them. One candle might show that buyers are stepping in, The next candle shows that they're getting stronger. Maybe the third candle shows that they're now in full control. That's how you read the market's intentions before big moves happen. But the thing is, technical analysis isn't about trying to predict the future. It's about understanding the probabilities of what might happen next based off what the market story is telling you. In our next episode, we're going to take everything that you've learned so far and put it into action. We're going to show you how to actually place your first trade, and we'll add some essential indicators that professional traders use to support their analysis.